and hearty northern Illinoisans who are not deterred by ice, snow, or those awful temperatures. Every morning that I wake up and know it's going to be slippery outside, I am so glad I am retired. And I do not have to stumble out to the garage. I do not have to worry about getting to work, though it was only ever 4 blocks for me. Good afternoon. I am Diane Bracken. I'm from Milledgeville. I taught in the high school in Milledgeville for 32 years. So when I come to this hospital, I can't tell you how many people that I have encountered that knew me as Mrs. B or Ma Bracken. So this whole business about all this privacy is kind of hard to do when your students grab you in the hallway and say, "Whoa, how are you? Why are you here?" You know, this kind of business. So we certainly appreciate the fact that you came out this afternoon. I know many of us are puzzled about what's going to happen to our taxes, our little extra, little egg nests that we have stuck around in the corners, and so we certainly hope that you will learn a lot this afternoon. And it is a privilege to welcome all of you to our charitable strategies in the face of tax reform. We have 3 very qualified speakers who will present some important information, not only for you, but I think for every single person that we can share this information with. First of all, we will have our semi-retired CPA, John Van Alstead, and Edward Jones, financial advisor, Nick LaRue, and also a young lady representing Ward, Murray, Pace, and Johnson, Amanda Barron, who will help us with all kinds of information, and I am sure we'll have a Q&A for you after our presentations. Exactly who is the Health Foundation, CGH? And our mission has always been to promote healthier living for the people of the Sauk Valley. And we have argued about how far the Sauk Valley really goes at some of our meetings. Well, we do not care how far you came or how short your trip was here. We are so glad that you are here to take in some of this good information. We, of course, are a fundraising organization, and you may have received a request for a donation from a club or some kind of other organization or individually. And of course, this room represents one of our most important bequests. Back in 1987, we received a $400,000 gift from the estate of Emo Ryberg. And of course, this is the Ryberg Auditorium. Giving takes a lot of shapes. Most of us think it's dollar signs maybe, but you know, the first gifts here were linens. And I remember when we found that out, and I know some of us were so amazed that how practical those very first gifts were. Today, we try to balance our requests so that we will have fundraisers that will suit the needs of our organization plus the hospital. We have been blessed with many people who answer our requests every single year. And I don't know how often, but Joan, how many years have we met our goal?
Every year.
Every year. Now, that's exceptional. It is very difficult, in some hard times, because we have gone through some hard time, to actually meet our goal. I believe that speaks just so much for Joan, her efforts to keep us all organized and to make sure that some of us old timers are able to contribute however we can. We have purchased all kinds of equipment. I know we've done some things for people who are chronically ill. We have purchased scales that actually tell you what the reading is for those people who cannot see their feet anymore. And that just kind of boggles your mind to realize that is out there, ready for help with other people. We have been organized for 32 years, and we have given nearly $10 million back to the community through our various fund drives. And so if you are one of those people that has answered our call for donations, we surely want to thank you today, and we are so glad that you decided to take part in this informational program this afternoon. I'll also have to put in a little kick for plan giving. And I am the chair of the plan giving committee this year, I think by default. Everybody else has done it. But it is our purpose to present information so that you would consider giving us a gift beyond just your yearly fund drive. So I think that's enough time for me. I think it's probably time for Roger.
Thank you, Diane. I'm Roger Waite. I'm currently the vice chairman of the foundation, and I've been a member since 2013. I'm a Sterling resident. I worked at Northwestern Steel. That's the way I came to the community way back in 1970 to work in the merchant wire sales division. And Tom Nestor and I, we worked together for a number of years. And Tom was a road salesman for Northwestern. And then after the downsizing of the wire division, I took a job with the state of Illinois as an administrator, and I was involved with the Department of Corrections. I was hired initially for Thompson, which didn't open because the state didn't have the funding. So then at that point, they sent me to Sheridan down in LaSalle County, and I was down there for 12 years. An administrator at that level is like a CFO. You handle the budget, you're in charge of all the business office staff, procurement staff, you do all the contracts and all that type of stuff. Today's presentation is part of our efforts to raise awareness about the foundation and to give you more information on financial topics. I'd like to introduce John Van Osdell, whose topic is the 2018 tax law changes. John is a certified public accountant, semi-retired from Lindgren, Callahan, and Van Osdell back in 2010. He is a member of the Illinois CPA Society and the American Institute of CPAs. He has been a CGH Health Foundation trustee since 1990 and is chair of the Finance Committee. He is currently chair of the CGH Medical Center Board of Directors and serves on its Finance, Executive, Planning, and Quality Control committees. He also serves on the board of the Dillon Foundation and is a member and treasurer of the Sterling Kiwanis Club. He and his wife Barb have 2 sons and 7 grandchildren. At this point, I'd like to introduce John. Go ahead, John.
Can you hear me? Can you hear me now?
Black, cold blue, ultrasound, vascular room. Black,
Just like that.
cold blue, ultrasound, vascular room. Black, cold blue, ultrasound, vascular room.
Okay. It's great to see everybody here. I think it's a lot more people than I was told would be here. That's great to see. And I see some people I've known for a lot of years. I see some people I haven't seen in a lot of years. Some I've seen just in the last few days, but anyway, it's great to be here. It's great to see this kind of size of crowd. So, not a great topic to talk about though. The taxes. That's not much fun, but we'll deal with it. Mainly, we're talking about new tax law. Are there any farmers, active farmers in the room? One of the newest laws of all is happening even today on farmers. Normally they're supposed to file their tax return by March 1, like tomorrow. Today they're announcing that you don't have to file it by March 1 after all. You can wait till April 15. It's just a brand new, hot off the press kind of a thing. So the new laws are happening all the time. There's something going on. And that's not a very good one too. The reason why is they've made some of the laws so complex that they haven't had time to issue the final regulations and give the people a chance to figure out what they mean. So it's very frustrating in that respect. And here, so starting out with another frustration on my part anyway is, remember in the political campaigns, and this is going on the last presidential one, and I think the one before that, I said, we want to simplify taxes. We want to make it so simple you can put it on a postcard. And everybody will just send in a postcard. Now, first of all, why would you send in a postcard? It shows your income. But I guess they'd have an envelope for it probably. But anyway, they sort of accomplished that in this tax act that was passed a year ago and is starting to come into effect right now. So there is a postcard. It replaces the 1040, the 1040A, the EZ. It's am I going the wrong way? There it is. I'm going the right way now. There's the postcard. That's actually on a full sheet of paper. I have the real one right here. We just chopped it off with what's there, but that's the first postcard that they talk about. That's one postcard. There's another one. Start counting, that's 2. There's another one, 3. Another one, 4. Another one, 5. Another one, 6. Another one, 7. And there is an 8th one. But the 8th one is if you're a foreigner, if you have to file certain foreign disclosures. But here they've taken 2 pages that we used to have, turned it into 7 or 8. So, but they are postcards, sort of. So, it's not something that's been simplified. There's no question about that, the postcard is something that they've maybe fulfilled a political promise with, but it's made things more complex. Because everything that's on those 7 pages or so used to be on the 2. Maybe a few little extra things now, but that's what they call simplification. If you do your tax return on a computer, or best of all, if you have somebody else do it for you, but the computer will handle all that. But if you have to if you try to do your return manually, you're taking your numbers from, there's still the Schedule A and B and C and all the different ones that you fill out first, and then you take those numbers forward. You used to take them forward to just those 2 pages. Now you take them forward to one of maybe 7 pages, and you got to figure out which one. Then you take it from one of those 7 pages to the front schedule. All sorts of potentials for errors and confusion, and so that's progress, I guess. So that's the postcard. I'll get this right as to which way to hit this key. I'll probably mess it up several times. Getting into some of the law changes that impact the most of all of us, and I'm only focusing primarily on individuals here, but one of the things are going to be different, especially if you do your own return. If you have somebody do it, or you do it on TurboTax or whatever, you might not notice some of these subtleties, but one of the big things that's been around forever was for every person in your family, you got a deduction, or they called it an exemption, and it was a subtraction off your income for when I started being a tax preparer. I think the exemption was like $600. Last year it was $4,050. So for every person in your family, you got to take a $4,000 deduction. So if you had 4 people in the family, you got $16,000 deducted against your income, your taxable income. This year, 0. Totally got away from that. It's all gone. So that's one major difference in the way the taxes are computed this year. So it doesn't really matter how many are in your family anymore. this one is huge, the standard versus itemized deductions. You know, if you tally up all of your medical expenses, all your donations, all your taxes, state and real estate and so on, interest expense, that's called itemizing, and you tally all the numbers up, and if it exceeds a certain threshold, then it's better to use that tallied up actual number, or you get what's called a standard deduction. Up until this year, the standard deduction was about $6,000 for a single person and $12,000 for a joint return, two people. This year they changed that to where now that they've approximately doubled it. So the standard deduction for a married couple is now 24 to, if you're over 65, it can go as high as about 27,000. So that is a huge change, because so many people are just not going to have to bother with keeping track of all of their deductions anymore. I think of the returns I've been doing this year, I bet it's been probably a 90% changeover to where about 90% of the people are now just taking that standard deduction. It's more than what you can come up with. So it's going to make things a lot different for everybody. And they can always say it's simplified because now you don't have to keep track of all those expenses that you used to keep track of. Well, yes and no. You still have to maybe keep track of them just to see what they're going to add up to, and to see if they're going to go over that 24 to 26,000 or 12,000 if you're single. So it is simplified, no doubt about it, except for maybe the record keeping. But if you know without a doubt you're not going to hit one of those numbers, then it is much simpler for you. So that is a huge change. It's really, I'm seeing the impact of that significantly with the returns I've been working on so far this year. But speaking of the deductions, the medical expense deduction is a little different this year. It's a hard one for anybody to achieve, because to be able to take medical, you have to make a computation of how much your income is and take this year 7.5% of that figure. And the medical expenses only count when they exceed that 7.5% number. So it's very rare that I even see anybody getting a medical deduction. The biggest one I see where that works for people is sometimes if somebody is in a nursing home based on doctor's orders, obviously the cost is way up then, and those people usually can take a medical deduction. But if you have any kind of insurance at all, you're probably not going to ever take advantage of medical. But it is still there. And again, it goes towards figuring out the amount that you compare with the standard. The SALT cap, the SALT stands for state and local tax. This was a big one about a year ago because, well, it's effective for this year, but the planning that was going on, not this past November, December, but the one before that, people were prepaying their real estate taxes and so that they could get a deduction that otherwise this year now might be capped and you might not get it. So the new law is that you get a $10,000 deduction and no more for your state and your state income tax and your real estate taxes. If it goes over that, you stop at 10. It's just wasted. So a year ago, people were paying they were doubling up their real estate taxes to get the deduction. So that one is really being complained at by some of the high-tax states, New York, for example. Illinois is sort of on the verge of that, but Illinois or New York and California have really been screaming that that's not fair to those states that have such high both real estate and state income tax. But it is what happened. Now the charitable donations, we'll have more on that in another part of the segment here. But the number one deduction limit is increased to 60%. I think I've only had 2 cases in 40 years of doing income taxes where somebody gave away more than half of their income. The old limit was half. If your income was $100,000, you could donate up and take a deduction for $50,000, 50%. Now you can take a deduction for up to 60% of your charitable donations, which would be $60,000 in my example. But you don't see it that often that people are that charitable. It's nice to be charitable, but to give away half of your income or more is sort of rare. The new law, so the new law raised that from 50 to 60. The new law also hit harder on the requirement that you keep track of your donations and get receipts at the time that you're making the donation. It doesn't work to get the receipt after you've been audited. You need it right away And it's hard to get it if you wait a couple of years and then get audited, try to round up somebody that'll give you the receipt. So you need that receipt right away anyway to document anything over $250. And the last one is the qualified charitable distribution that it's a great planning tool. Nick is going to cover it in more detail when he gets up here. But to make a donation, especially with this higher standard deduction, you're going to get $24,000 to $26,000 anyway. And so the charities, sometimes making a donation to a charity doesn't do you any good because you're getting such a high standard deduction. So this is a way to get around that, but you have to be old, 70 and a half, you have to be old to get that. So that's but Nick will cover that in more detail a little later. But that's a very positive change. Okay, mortgage interest. Anybody have a mortgage that pays interest, or that is over $1 million, not the balance? We can forget about that one probably. But if you have $1 million mortgage, then you've got some new rules to follow. The one that is appropriate here is the home equity deduction, the lower section there. If you have in the old days, you could have a home equity loan, you could borrow up to $100,000 against your house. You could take that $100,000 and go on a vacation with it. You could buy a new car. You could do anything you wanted with it and still be able to deduct the interest. Now the new law is that if you borrow money on a home equity loan, you've got to use it on your home. You've got to do something to improve your home. The old home equities, pre-new tax law, are still okay the old way. But the new ones, you have to use that money on your house to get the deduction. This is another really big one, miscellaneous itemized deductions. If, again, you are even going to itemize to begin with. But in the old law, bottom of the Schedule A, if you recall how the forms work, on the bottom of that schedule there was a place for miscellaneous itemized. It was unreimbursed expenses from being an employee. If you incur a lot of expense as a part of your job and you're a W-2 type employee, you could deduct those expenses. You could deduct investment expenses and tax fees. That's hitting Nick and I. Yeah, those are gone. And well, hobby expenses, that's sort of minor, but they've been questionable to begin with. But all of these expenses, first of all, in the old days, you had to tally up how much they were, compare that with 2% of your income, just like the medical, except with a 2% figure, and you deduct only the excess over the 2%. These were also expenses that the IRS agents had difficulty auditing. Sort of gray sometimes on what these miscellaneous deductions were and how legitimate maybe they be. I think this is one of the primary reasons maybe this law got changed, because now they are just gone. No debating anymore, no audits, no questions of is that a business expense or not. They're just gone. You can't deduct any of them anymore. So that's another slice of the deductibility here. I had, this year, I've not too many people get impacted by this, but I had an over-the-road trucker drives a semi all around the country. The old law for unreimbursed employee business expenses, he could deduct $65 a day for every day he was on the road. And over the year, I think he tallied up a deduction of about $20,000 and was able to take almost all of that on his return. That's totally gone for him. It cost him about $7,000 to $8,000 in higher taxes. So he wasn't a happy camper. So, but there aren't too many situations where that happens. I do have some other clients with the investment expenses where they have managed funds, and quite a bit of managed funds, and they might be paying $10,000, $20,000, $30,000 in managed investment advisory fees, and those are gone too. So those are all things that are hitting the taxpayers, all of which is to some degree, a lot of it offset by the fact that we've got that higher standard deduction now. This is another pretty big one. It might not impact too many people in this room, but if you have your own business, if you run a business like a sole proprietor business, or again, like if you were a farmer, there is a new deduction where whatever your bottom line is, whatever you've made in your business for the year, you can also take an additional 20% deduction on whatever that figure is. If you have a business where you made $40,000, you can take a 20% deduction or $8,000 just for having that business. This was done to make it sort of a parity with the fact that they lowered the corporate tax rate so drastically. They lowered the, corporations had a tax rate that could be as high as in the 30% range, and they lowered that down to 21. So to be fair with the other unincorporated businesses, they brought in this benefit or provision. So this is a big one for people that are self-employed. There's a few other situations where it applies, but the most obvious one would be the self-employment income. So that's a pretty good deal. Let's see, child tax credit. This is, if you got a family, this is a great one too. There's a child tax credit. In the old law, you got $1,000 if you have children, and they had to be 16 or under. You got $1,000 as if it was withholding or an estimated tax payment. You got $1,000 off for every child that met those criteria. Now the credit is $2,000 a child. So family with 3 or 4 kids under 16, sort of a bonanza to them. They get $2,000 times each child. That was a little bit of an offset, I think, too, to the fact that they can't take any exemption for them anymore. The other thing is that credit phased out if you got to be too high of income, and it still does, but they've raised the threshold for your income up to about $400,000. So more people will get that, and that's a very good deal for that one. And if you have a child that I mentioned 16 and under, what about your 17-year-old that's still in high school, or the 19-year-old that's still in college? They don't get that $2,000, but they do get $500. Each one of those. The time you're paying the most money out on it when they're in college, you're getting the least credit. But that's fair. But there still are college credits too, but we're not covering those today. Moving expenses, I get the question all the time about I'm moving across town or whatever, can I deduct it? No. The old law was that you could only deduct moving expenses if it was over 50 miles and it was related to a job. That's just gone, except if you're in the armed services now. So that one's gone. There's interesting stories about the reaction to all of these deductions, changes, and so on. And I got a call a week or so ago from a lady down in Florida that I do her work, and she said, I was sitting in church, and the 2 ladies behind me said, there's no more deductions. You can't deduct anything anymore. Is that true? And the stories just fly, and I told her, of course, a real fast summary of some of the things I just mentioned here. There are still the deductions, but I think the reaction there is that, well, those deductions aren't going to do you any good anymore because you'll just take that standard deduction. So, but there's just all sorts of misconceptions and half-truths and so on going on right now. AMT, that's a tax it was originally implemented to tax millionaires, and they've liberalized that so it doesn't affect as many people. So fewer people will be caught by it. The last thing I wanted to mention was to just give you a real-life example here of a return I just did. Names plotted out, of course. And this now, other way, John. I was nailing you, wasn't I? Okay. Okay. This is a client of mine that made about $50,000. This column is 17. This column is 18. And so he made, amazingly, he was within, I think by the time you got down to his total income, he was $34 different between the 2 years. Okay, so in the year 17, he was single, so he got a $6,000 standard deduction, and he got that $4,000 exemption I was telling you about. So he could take $10,000 away from his income, and he'd have a taxable income of $38,000, and he paid a tax of $5,300. Now this year, he's got that pretty much the same income. Now he's got that higher standard deduction of $12,000, single. If he was married, that'd be $24,000. And then, see, he has 0 exemptions. That $4,000 exemption is gone. So but overall, he's a little better off on taxable income. His income is taxable is now $36,000, and last year was $38,000. And then you look at his tax. Last year was $5,300. This year it's $4,200. So his tax has gone down $1,100. But then you jump down, I'm just going to jump right down here to the bottom. I don't know if all of you can see, it's sort of low there. But it looks like he only got a refund reduction, because his refund last year was $2,100, this year it was only $1,900. So this is what's been in the in the press like crazy, that I'm getting a smaller refund. The tax law didn't save me anything. But the tax law saved him. Where was his tax here? His total tax was $1,100 better. The reason he got a smaller refund, they didn't withhold as much all year long. As soon as the law changed, everybody that was working got an increase in their take-home pay because they didn't withhold as much anymore. So the tax law is working, and I'm seeing this on virtually everybody, that if you apply the new law to the same income as the person had the year before, taxes are going down, except for my trucker client. But it is going down, but they're not seeing all that flow through to a refund now because they got some of it during the year. So when you hear people saying, well, gee, my refund isn't as good, the law didn't work for me, it's probably not true. It's probably this situation here. So I did want to take a look, just a couple seconds. That's another one of those stories that's flying around out there. So with that, I think I've covered everything I wanted to address, and I think Nick is either next or somebody is next to introduce Nick.
Oh, I am.
There you go. Okay. Okay. I better.
Thank you very much.
I better
I am on the air again, so thank you, John. You can see that when we have foundation meetings, we get the latest poop every single time. So he knows what he's talking about. Now we have a new face in the community and a new face here in our Planned Giving Committee, and I would like to introduce Nick LaRue, who is a financial advisor for the Edward Jones system here in Sterling, and he has been here since 2008. He came here after Rich Kuhn retired, I believe, and is a limited partner. And I don't know how you had room for a health foundation. If I can read off all the organizations that he volunteers at. He's as bad as I am. Just ask my husband back there. He tells me I'm a professional volunteer. He's, of course, on the CGH Health Foundation board. He's in the Sterling Kiwanis Club, Sterling Main Street, Sterling Noon Rotary, Sterling American Legion. Good for you. He and his wife Jennifer have been married 10 years and have one daughter, Olivia, 7. Busy little second grader.
First grade.
First
Birthday
grader.
today. Birthday's today.
Oh, okay. He has his bachelor's degree in finance from Southern Illinois University at Carbondale, and he was also involved with the Illinois Air National Guard while you were a student, and since a medic. So, very good for you. He's going to talk to you about helping clients prepare for and live in retirement. Make sure we have enough money on the 25th of the month. All right, Nick.
Thank you, Diane. Thank you for that example, John. It's on here. No. How's that? There we go. I think that's important, that example right there. As they say, you gotta kind of do the math sometimes and look at the numbers and really see what the headlines are talking about. And speaking of headlines, we're going to talk about RMDs and QCDs. Besides alphabet soup, what are they? An RMD is a required minimum distribution. And why do you have to take it? Quite simply because the government said so. In reality, years ago, and we see this quite often this time of year, working clients are sitting down with their tax preparer like John, and they're finalizing their return, and they're looking at all the numbers like you just saw there earlier. And they'll come up with the final calculation with the amount of taxes that are owed. And many times the accountant will make a recommendation, well, if you contribute, if you put money into a traditional IRA, you would then receive a deduction, therefore lowering the tax that you have to pay to the IRS. So that's a deduction at the time of your filing. retirement accounts are tax deferred. They're not tax-free forever. The most other common reason that you see is if you were a participant in your workplace retirement plan, very often folks contribute or defer some of their salary to a workplace 401k. That money that goes into that retirement plan goes into that investment account before the IRS ever gets their hands on it to tax it. So that's how you came about with this type of retirement account. Well, some folks, they may be questioning, do I really have to do this? And, what are the penalties and the casualties if I don't? One of the steepest penalties in the IRS tax code is this right here. A 50% tax on the amount that otherwise should have been distributed. What that might mean is if you had a required minimum distribution in the amount of $10,000 and you failed to do so, you could have to pay a tax of $5,000. Now, a lot of folks I talk to and work with really appreciate the time and the effort and the longevity that they put in to accumulate all their wealth. Many don't want to just let that go away very quickly to the IRS. But I don't like to scare you. We see this quite often just in just the evolution of life and savings and retirement in general. You have multiple retirement accounts in many different places. You can work with your tax preparer. There's an IRS form that you can file and just give a detailed explanation in the details of why the distribution was missed. And so often if you own up to it, they're willing to work with you there. But it is important to keep track of it because you let that go on for a couple of years and it really starts to add up there. So what's it mean and how do you actually take a required minimum distribution? Well, as I said earlier there, this is a tax deferred. It doesn't mean it can go on forever, indefinitely. I'm going to walk through this a little bit here because it gets a little busy. Your first required minimum distribution must begin no later than April 1st of the year following the year you turn 70 and a half. Everybody catch that? Let me walk you through an example. So if tomorrow's your birthday and you turn 70, you're turning 70 March 1st, 2019. Your 70 and a half birthday would be this September. 70 and a half. Why they came up with the half-year mark on RMDs, I really don't know. Probably trying to simplify that tax code, right, John? If you so choose, the very first required minimum distribution, you can wait until April 1st of 2020 to remove those dollars from your retirement account. They just give you a little bit of flexibility that first year. Now there's a catch to that, and it kind of ties into the last point here. In future years, your required minimum distribution must be removed no later than December 31st of that year. So in that example, if you wait to delay your first one until 2020, you actually end up taking two distributions in the calendar year 2020. The one you delayed and the one that's calculated at December 31st, 2019. So you want to be careful there. Sometimes you have accentuating circumstances, maybe you have some additional income coming in that year. You want to talk with your tax preparer and see if it makes sense delaying that first one. It's just an important thing to keep an eye on. So what's the math behind the calculation here? Here's how it works. And I think Diane just passed out a worksheet. It's really quite simple, and the IRS is actually pretty good at doing the math for you and showing you how to do the calculation. But this is what it looks like. They take a snapshot of your of your IRA account balance at year end, December 31st. And we do some math based upon the age or the birthday that you will have in that particular calendar year. So if you look at the very first box on that worksheet, at age 70, you'll see that they have a divisor of 27.4. So you take your dollars in your IRA and you divide it by the divisor in the year that you're having your birthday. In this case, 27.4. Know that 27.4 is not a government estimate of how many more years you're going to live. It's just a factor, essentially a calculation. What they want you to do is really withdraw most, if not all, of your retirement dollars, pay tax on it every year over your expected longevity. Well, what you'll see here, with the same IRA account, $100,000, fast forward 10 years, that first year you had to withdraw about $3,600. 10 years later, you've matured to age 80, and now that distribution on the same $100,000 IRA is over $5,300. And we'll fast forward here till 90, you see it's about $8,700. If you're just looking for good rules of thumb, if you're talking with friends or family that may be approaching these distributions, good rule of thumb in your 70s, we always tell clients around 4%, 6% in your 80s, and in your 90s it really starts to ratchet up there, 8% and beyond there. Now, for many clients, they'll have dollars left over in their retirement accounts, and Amanda's going to speak with you shortly about some advanced estate planning strategies for dollars beyond your longevity. So what are your options with the required minimum distribution? As John alluded to earlier in the example, when you withdraw money from your retirement account, it's a taxable distribution. So that $3,600 that we looked at earlier, it gets tallied on with your income from Social Security. It gets tallied on with pensions. If you have rent income or farm income, that all gets lumped together to give you a top line number. Most of our clients elect to keep it. You can move it to your bank account. This is traditionally the most common. The money just goes right in your bank account and you spend it for your everyday living expenses. You can elect to reinvest your R&D funds in a non-retirement account, purchase a CD or a mutual fund or something of that nature. You can transfer your retirement account dollars or your retirement assets in kind out of the account to your non-retirement account. We do a lot of that with Edward Jones. I will give you a word of caution there. When we transfer assets in kind, we cannot withhold taxes from a mutual fund or a stock or a CD. So you'll want to work with your tax preparer to really determine what tax would be owed. What are some other options? Consider making a gift and making a difference with a qualified charitable distribution. Now, a little history on the qualified charitable distribution. It was introduced in 2006 as part of the Pension Protection Act. And since that time, it had been allowed, on again, off again, extended, turned on again, and made retroactive. And sometimes the way the IRS writes rules, it just got a little complicated there. But finally, in 2015, it was made permanent. So it gave clients and accountants and advisors really time to plan and work with their clients. What it is a non-taxable gift to a charity. I'll repeat that. Non-taxable. In the earlier example, any money that you withdraw from the retirement account gets tallied up with all the other income. In this scenario, if you send these dollars to a church or charity, CGH Health Foundation, directly from your IRA, it would satisfy your requirement of that minimum distribution, but now it's not taxable income. And like John talked about earlier, that threshold has really been raised to qualify for itemizing your tax deductions there. A few rules you got to be mindful of, as you can see here. You must be 70 and a half. If you're so inclined, you can contribute up to $100,000, and if you're married filing a joint return, your spouse can contribute up to $100,000. A few benefits here. Oftentimes we see folks, as we looked on the example earlier, as you get in those more mature years, your R&Ds, your distributions become quite high. And a lot of times that can affect how much of your Social Security becomes taxable. Again, for those who do not itemize their tax deductions. I want to emphasize that this is something that we've worked very hard with many of our clients. So often we saw many of the clients doing the first scenario, their option of just keeping the required minimum distribution and putting that in their bank account, and then they would write out their checks to their charities and churches of choice and so forth. And that's great, but if we can help folks just save a few more dollars in their pocket, a few more dollars in the charity's pocket, and a few less dollars in the IRS's pocket, I think that's really a win-win for everybody. If you'd like more detailed information on the qualified charitable distributions, I've got a research sheet here with me. You can see me afterwards. I will emphasize, right now, this is a very manual process, and it's important to keep very detailed records. What we advise our clients is that you notify the charity that you'll be making a gift in this fashion, to keep an eye out for a check from the financial institution who has your retirement account. Once the charity receives that check, you want to keep records of the check. Again, substantiated documentation. Right now, we get this question quite a bit. When you receive your 1099 for your retirement account distributions, there's no specific code on the 1099 designating that you did this gift, this qualified charitable distribution. You really want to work closely with your tax preparer, tell them that you're doing this, and have the documentation and paperwork to keep up with that. I'll finish where I started. Thank you. I hope you have a better understanding of your IRA, your required minimum distributions, your qualified charitable distribution options, and most importantly, that you can make a difference when you're thinking about a qualified charitable distribution. And with that, next I'll turn it over to some estate planning strategies with Ms. Amanda Barron.
Thank you, Nick. Everybody got that figured out now, which way to go? To wrap up our presentations, we'll hear from attorney Amanda Barron, who will speak on achieving personal and charitable estate planning objectives. Amanda began with Ward, Murray, Pace, and Johnson back in 2015. She specializes in trust and estate planning, probate, and trust administration and real estate. She earned her law degree from Northern Illinois University College of Law in 2015, where she graduated magna cum laude. She earned her undergraduate degree from Augustana in Rock Island, where she also graduated magna cum laude. She's a member of the Omicron Delta Kappa National Honor Society, and she was admitted to the Illinois Bar in 2015 and is a member of the Illinois State and the Whiteside County Bar Association. She also served as one of two reporters for the Illinois State Bar Association Special Committee on the Impact of Law School Curriculum and Student Debt on the Delivery of Legal Services in 2015. She serves on the boards of United Way of Whiteside County and the Sauk Valley Area Chamber of Commerce. Amanda?
Is this one turned off, or?
It's on.
I'm good, okay. Well, now that you guys got the long resume version, I am Amanda Barron. I grew up here in Sterling, Illinois. I graduated from Sterling High School in 2008, and then I did go on to Augustana for undergrad, and then went on to NIU for law school. So I'm kind of a homebody, haven't really strayed too far. While I was in law school, I did get the privilege of clerking at Ward Murray and was offered a job, and so I came back and now an associate attorney over there. I grew up just north of Sterling. My parents' farm still live over that way. And I have the privilege of working with a lot of farm families, doing a lot of estate planning and real estate in the area, along with other folks that come see me looking for some assistance with getting their estate plans up to date or getting their house sold, whatever the case may be. So I'm really excited to talk to you guys today. And if I can figure out how to use the clicker. Oops, I really screwed it up.
No, you haven't. I need to set you up.
take two. So a lot of, the first question that I get from a lot of my clients when they come in is, what is estate planning? So kind of similar with what we've talked about today with some of the tax law changes and some of the ideas that you have with your retirement accounts. There's a lot of misinformation about what exactly is estate planning. So we all have an estate. Your estate is comprised of, what do you have? What are your assets? Your real estate, any vehicles you might have, any retirement or investment accounts. So everyone has an estate, and an estate planning is the plan that you put in place in advance that tells everybody what your wishes are about how you want to leave your property.
And I'm not sure.
It's green.
Can you do a check with your mic?
Check. I don't think it's on.
Yes. Maybe a different mic.
Is that better?
Yeah.
I'd say so. All right, so getting back on track, your estate plan is what lays out what your wishes are about how you want to leave your property. Now, if you pass away and you don't have any kind of estate planning in place, you don't have a will or you don't have a trust, and we'll get into both of those in a little more detail, guess what? The state of Illinois has a will for you. The Illinois Probate Act actually provides what happens to your stuff when you pass away. And it probably is not what your wishes are. So it's important to take the time while you're living to put a plan into place that expresses your wishes of how you want to leave your property. So estate planning is made up of several different components, which I really like this chart because it lays out all of them for us. So we've got trusts and wills, which I've already mentioned we're going to be dealing most of our time with today. You've got healthcare directives or healthcare power of attorneys and other power of attorneys. Those are used while you're living. If, for example, you get to a point where you're not able to manage your finances or make healthcare decisions for yourself. These two, if you have that planning in place, can name someone to assist you with those things. This is the planning for what happens after you've passed away. And then probate or estate administration is the process of what happens to your stuff after you passed away. Getting your stuff out of your name and where it needs to go, whether it's to your beneficiaries, designated beneficiaries, and so forth. So again, today we're going to spend most of our time here on putting an estate plan into place with either a will or a trust. So another one of the questions that I get a lot is, what's a will? What's a trust? What do I need? How do I know what I need? So starting with a will allows you to communicate your wishes about how you want to leave your property. So we've already kind of mentioned that. That's what an estate plan does. It also, very importantly, nominates the person you want to act as your executor. Who do you want to be in charge of managing your estate administration when you pass away? This is actually a really important consideration when you're doing your estate planning. In the past, I've heard a lot of folks come in and they say, well, it's going to be my oldest child. Well, think about that. Is your oldest child of your children the most experienced and able to manage finances? Do they have the time? Do they live close? So sometimes there's more to think about. Is this a person that's going to be able to manage this process and make sure that my estate gets administered the way that I want it to be? Your will also names your beneficiaries. So who do you want to leave your property to? Do you want to leave it to just your family? Do you want to make some charitable distributions? Those are all wishes that you can put out in a will. And it also importantly sets forth how your estate is to be administered, so the order of how things get administered. So I've already mentioned that if you pass away without a will, the state of Illinois has one for you. So a common term that you will hear is intestate. So if you pass away without a will, you pass away intestate. So some of the confusion with some of these legal terms, if you think about it, if you have a will, it's your last will and testament. If you pass away without a will, you pass away intestate. You do not have that last will and testament. So there's some Latin background in there. We won't get into that, but that's how those words are derived. In contrast, a trust is another estate planning document similar to a will, but what it actually is an agreement that creates a fiduciary relationship. So if you have, we'll use a living trust as an example. So if you as the settlor of the trust create a trust, and you are the trustee, you then hold assets of the trust as the trustee. There's a fiduciary relationship there that you are how you are holding that property. You still would have a will. So if you think about it, that you've got different buckets for your assets. So your trust now has the majority of your assets. Your trust bucket has everything. But we still have a catch-all will called a pour-over will that says when I pass away, if there's anything that didn't make it into my trust bucket while I'm living, that will then pours over everything into that trust, and then it's administered according to the terms of your trust document. Similar to a will with a trust, you'll also want to name a successor trustee. So if you're the trustee while you're living, you'll want to think about who should I name as my successor trustee? Who do I want to be responsible for administering my trust when I pass away? And then that trustee, as we mentioned before, owes a fiduciary duty to the beneficiaries of the trust. Some of the key differences between a trust and a will are, first, that a will, in most cases, so this is generally, requires probate in order to administer your estate. So that's another question that I get a lot. Amanda, what's probate? Probate is the court-involved process of administering your estate. So as an example, just because you nominate someone in your will as an executor does not automatically make them the executor of your estate. In order to formally become the executor of the estate, they would need to go to court, petition the court to admit your will to probate, and to appoint them as the executor. If the court does so, then they get issued letters of office, and that actually is what gives them the authority to go about and administer your estate. A probate estate administration is of public record, and also when you pass away, your will is of public record. So Illinois law actually requires that when someone passes away, their original will is to be filed in the circuit clerk of the county of where they were a resident. So if you passed away here in Whiteside County, your will would need to be filed with the circuit clerk of Whiteside County. In contrast, a trust is a private document and in most cases does not require probate administration in order to administer it. So if privacy is something that you're particularly concerned about, a trust is a good estate planning vehicle for you because it's not a public record. It also has a little bit easier of administration, whereas with an executor, they have to go to court to get appointed. The successor trustee would be able to step right into your shoes and begin administering the trust assets without the necessity of going into court to be appointed. So when I sit down with clients, a lot of times a lot of folks have heard about a will or a trust, and they want to know what estate planning vehicle is right for them. So the things that I take a look at and I discuss with them are identifying their assets. So one of the key things is what's the value of your assets? Do you own any real estate? Do you have any life insurance? Do you have designated beneficiaries on those life insurance policies? Do you own the life insurance, or does someone else own it and it insures your life? What about any retirement accounts? What kind of a retirement account is it? Is it an IRA, a 401k? And are there any estate tax concerns? Which also circles back to what are the values of your estate. Now, along with some of the other changes that were talked about earlier with the change in the tax law, one of the other important changes is that the federal estate tax exemption amount went way up. It's for 2019, it's at $11.4 million. So around here, that probably doesn't affect a large amount of people. It certainly impacts a few. But in Illinois, the exemption amount remains at $4 million. And that does tag quite a few people. So sometimes part of the estate planning analysis is, do we need to do some planning in order to minimize potential Illinois estate tax concerns and sometimes federal estate tax concerns. And then the other, and probably the most important, is what are your goals? So identifying what the client's goals are, or your guys' goals. So if you're going in to meet with an estate planning attorney, I would recommend that you sit down and think, before you meet with them, what are my goals? What do I want to happen to my stuff when I've passed away? So perhaps charitable giving is one of your priorities. Providing for family is usually a big one. A lot of folks want to see that, the life that they've built, the work that they've accumulated, they want that to pass on to their family and provide for them in the future. Another goal a lot of times that I see is preserving assets, particularly among farm families. It's important that the farm is preserved to go on to the next generation. So speaking from my own personal experience, I had the privilege of growing up on the farm that my grandfather farmed. My dad farms it now, and perhaps someday my brother would also like to farm it. So preserving an asset can also be a goal of estate planning. Another goal a lot of times for families is ease of administration. What can I do to get my plan in place to make this as easy as possible for my family or loved ones when I pass away? This is particularly of importance for individuals who have already gone through the process of administering an estate. If they've served as an executor or a trustee, those folks usually come in and one of their main goals is to make it as easy as possible for their family members. And then, as I've already mentioned before, privacy a lot of times is an estate planning goal as well. What can I do to make sure that this is not a matter of public record? So there are lots of different estate planning vehicles besides the different wills and trusts that we've already highlighted. There's many, many different kinds of trusts, many, many different kinds of planning that you can do with wills. So if, for example, we're trying to do some estate planning that minimizes estate taxes, we might include some marital trusts, some credit shelter type provisions. Within a will itself, we might also have a testamentary trust. So a testamentary trust is a trust that is created upon your death pursuant to the terms of your will. So I use testamentary trust planning a lot when I have young couples come in. So if you've got minors or you have kids that are under age 18, you may want to set up a testamentary trust that would only take effect if you passed away and a beneficiary of your estate was under a certain age, like 18, or a lot of times we use 25 anymore. Another estate planning vehicle are living trusts. These are used pretty frequently. So during your lifetime, while you were living, you set up a trust. You as a settlor set it up, and you might be the trustee of the trust, so you administer it during your lifetime, and you can go in and revoke it, you can amend it anytime during your life. Another type of trust might be an irrevocable trust. This is used sometimes to preserve assets. One of the downsides of an irrevocable is just like the name says, you can't change it. So once it's in there, you're pretty much set with it. So circling back to if one of your estate planning goals is that you're charitably minded, you want to provide for some of your favorite charitable organizations when you pass away, how do you go about doing that? So some of the most simple ways to do that is with a specific bequest. So using a will as an example, you might leave, and this is based off of my own experience, you can kind of see. So if I wanted to leave a specific dollar amount to Augustana College, I could say $25,000 to Augustana. You can also restrict the purpose of that specific bequest. So in my second example, the language I put here, $25,000 to Augustana to be used for scholarships for students pursuing a degree in elementary education. If you are going to put some kind of restrictive language in this, I strongly recommend that you and or the attorney that you are working with to prepare your estate planning documents contacts the charitable organization to make sure that you've got the appropriate language that they need in order to meet this restriction of the purpose that you want those funds to be used for. Because if you don't have the language that they need, they may have difficulty carrying out your wishes once you've passed. So how these specific bequests work is that these are some of the first distributions that are made during an estate administration. So assuming that you've got enough liquidity in your estate when you pass away, these will be some of the first distributions that are made, or these specific bequests. If for whatever reason you passed away, let's say you thought you had $50,000, but you actually spent it down in between the time of when you did your will and when you actually passed away, then the specific bequest would receive a prorated share of what's left. You don't see that too frequently, but just something to keep in mind. So if you left like a very large dollar amount and you didn't have sufficient liquidity. But otherwise, if you passed away and you've got the liquid assets on hand, those distributions are going to be made first. Another kind is to do a residuary bequest. So this can leave the balance of your estate after certain specific bequests are made, or a percentage of the balance of your estate. So in the example that I've got here, the rest, residue, and remainder of my estate shall be distributed by my executor as follows. 30% to the CGH Foundation, 40% to Augie, 30% to First Lutheran Church of Jordan. With either residuary or specific, again, you can make these restrictions if you want it to be used for a specific purpose. Again, you'll want to consult with that organization. You can do specific or residuary bequests in either a trust or a will. One of the things about a residuary trust to keep in mind is any specific bequests that you have will be made first. So if, for example, you don't have sufficient assets in your estate, and after all the specific bequests are made, if there's nothing left, your residuary beneficiaries don't get anything. However, on the flip side, if you have a rather large estate, and after your specific bequests are made, or even if you don't have a very large estate, but you don't have very many specific bequests, then the bulk of your estate is going to go to the residuary beneficiaries. So one of the benefits of this type of planning is that the charity that you name with the residuary could potentially receive a much larger amount than had you just picked a number on the day that you went and did your estate planning. So again, it really depends on what your goals are, where you want your stuff to end up. But this gives you the flexibility to potentially really give a lot to your favorite charitable organization. You can also do these type of planning as kind of disaster planning too. So if your primary goal is to provide for your family, and I've seen this a couple of times, as an example, a couple comes in, they've got one child, that child doesn't have any kids, they want everything to go to this one child. But what happens if that child predeceases them? What happens to their stuff then? So in that case, they may be more charitably minded, and they'll leave everything to that child. But if that child predeceases them, then they've got it in their will or their trust that everything then would pass. If in the event that child predeceased, then everything goes to the charitable organization of their choice, or maybe other family members and a charitable organization. You can allocate these out. So instead of 40% to Augustina, it could be 40% to your favorite niece or nephew. It wouldn't have to be like that. So there's lots of different ways. Another time that I've had folks come in where they're particularly minded with wanting to make some charitable bequests is in the event where their children are already doing very well successfully. So they don't necessarily need an inheritance from mom and dad someday. In that case, they may leave a specific amount, like $25,000 or $50,000 to the child, and then make a residuary gift to a charitable organization. Some other strategies that folks use, particularly in trust planning, it can be done in a will, but it's not usually done in a will, partly because it's a public record. But if you have concerns about a child being a spendthrift, so they're going to get a distribution and they're going to blow through everything, you have concerns about that, you can set up for a trust for the benefit of that child and maybe restrict distributions, an outright distribution to that child until they reach a certain age, like 65 or something. And then during that time, it's been done, when you have real concerns. So we'll use a lesser age, so that's in the shot. We'll say 35, so if you're worried about your kids. So during that time period, they don't get an outright distribution, but maybe the income off of that trust will go to a charity of your choosing. So there's lots of different options and planning strategies that you can do. Now there are also, just to wrap up, there's also some specific trusts that I just kind of wanted to touch on. And they have really complex IRS rules that apply to them. So if it's something that you're considering doing, I would recommend that you talk to your tax advisor to make sure that any kind of planning complies with the IRS rules. And also, as just a caveat, my rule of thumb that I always tell my folks when they come in is you want to make sure your right hand is communicating with your left hand. You don't want to have everybody operating without knowing what the other one is doing. So whenever my folks come into me, if they're working with Nick, I tell them, make sure you go over and talk to Nick and make sure your designated beneficiaries conform with the updated estate planning documents, and then you should also go and see your tax preparer and make sure there's not any adverse tax consequences of some of this planning that we might want to think through. And there's been many times where I might pick up the phone and talk to Nick and say, hey, this is the planning we're looking at doing. What do we need to do to make sure it comports with all of Edward Jones' requirements? So with that being said, the two specific charitable type of trust planning I wanted to touch on today are a charitable lead trust and a charitable remainder trust. So with a charitable lead trust, you set the trust up for a certain term. So it could be for your life or it could be for the life of another beneficiary. So if I wanted to set up a charitable lead trust, I could set it up that until or during the term of my life, a certain charity would receive the income off this trust, at least on an annual basis. Sometimes you can do it semi-annually or quarterly. And then when I pass away, the balance of the trust then, or did I get those flipped? Then the balance of the trust then goes to the family members or whoever I want it to go to. The charitable remainder trust is the inverse of that, and I might have gotten those flipped actually. But at any rate, these trusts allow you to have, or with the charitable remainder trust, then the charitable remainder trust then has the income coming to you during your life, and then on your balance, the remainder gets distributed out to the charity of your choice. So the charitable remainder trust is really appropriate if you still need that income stream during your life, but you have charitable goals. The charitable lead trust is sometimes used in that same kind of idea where you don't necessarily want an outright distribution going to a beneficiary. So, or if in the example where your kids already are independently financial and you want to provide for the next generation, you might have the charitable lead trust be for the term of your child's life and then end on that child's death, and then the balance go to a grandkid or something like that. Again, there are some significant tax implications from doing these, so you would want to definitely talk with your tax preparer if that's something that you're interested in doing. So with that being said, that's what I've got for today. So hopefully things are a little bit clearer on estate planning for you guys, and I thank you for your time.
As I said earlier on this afternoon, John, if you come up too, we need a little Q&A for the audience, so we've asked these, I can shout for a little while. These three presenters will be available here for a little while to answer questions.
I think yeah, mine's working.
Do you know what the Illinois estate tax rate is?
It varies. So it depends on what you have over the exemption threshold. So you pay tax, so you have the $4 million exemption amount, assuming you haven't used any of it during your lifetime. So anything that is over that $4 million then gets taxed. On one estate that I was working on this year, it came out to be about 28%. But again, it varies depending on the amount that you exceed the $4 million exemption amount. But that's also a place to potentially do some charitable planning where you could have values that, any assets that exceed, you could do some contingency planning. But if you exceed the Illinois exemption amount, that amount would go to charity and potentially minimize that estate tax consequence. If you want to answer any of that.
I agree. It varies. I think it's a sort of a simultaneous equation kind of calculation, isn't it?
Yeah.
The biggest part of that, I would say, is just to keep updated with the rules, and because they do change.
My rule of thumb for folks too is at a minimum you should dust off your estate plan every 5 years and make sure that it still comports with what your wishes are. A lot of times there might be births in the family, deaths in the family, and you haven't updated your estate plan. And then that's also a good chance to touch base with either your accountant, your attorney, or all of us and see if maybe there's some laws that you are unaware of that might make sense to update your plan for. for as well.
Yes, ma'am.
If I leave, if I give an amount to a charity, in my case, the church, which would be shocking. But if I did that, is that part of the standard deduction? Or is that in addition to the standard deduction?
When are you leaving? Have you died and you're?
No, I'm
you're-
giving it right now.
You're giving it right now?
Right now.
It would be compared with the standard deduction, and if it pushes you over the standard deduction threshold, then you get it that way, yeah.
So an example might be $10,000 gift
Right.
would not exceed that standard deduction amount. $50,000 gift would.
Yeah, right,
Got it.
okay.
Yeah, you alluded to it, John, and then Nick, you mentioned about the importance of getting receipts from the charity when you've made the donation, and that it should be, get there quite quickly. I didn't this year, so I have all the backup paperwork, but I never received a receipt from the charity that I'd made the donation. I think because the CEO of the charity changed, and and it's a small organization, and I think it probably just got lost, Do I need to contact them and make sure that I get a receipt to keep with my records?
Yeah, I'd say still go ahead and get it. It's better to get it right away. But I think the rule still is that if you have it by the time you file your tax return, how they would ever prove that, I have no idea. But you should have it by the time you file your tax return for the year in question. Right?
Okay.
And that receipt, by the way, is always supposed to say that you receive no goods or services in exchange for the donation. And without that, I know there was a case in Texas some years ago where somebody had the receipt, but it didn't say that no goods or services were received, and the IRS was real ornery about it and discounted a huge deduction for somebody. So, and it's not really the individual's fault there, it's the charities, but I'm sure CGH Foundation puts no goods or services on every donation, right?
Yes, we do.
Amanda, if you have a living trust, do you have to go through all that estate planning? If it's pretty simple about with the beneficiaries and so forth, do you need an estate planning? Or is that?
I'm not quite sure I understand your question fully, but if you have a living trust, then you have an estate plan in place.
It's in place, okay.
But I would still recommend, like I said, if it's been some time since you've looked at it, dusting it off and making sure that it provide, how the dispositions are or how you want them to be.
Yes, sir.
In estate planning, how many different costs are there?
It varies, and it depends. So at our office, we charge based on the billable rates of the attorneys that you're working with. So the kind of standard rate of our attorneys at our firm is $240, but I can't speak to other firms. But it's based on the amount of time that's spent working on the matter. So that's always a discussion. If your attorney, when you sit down and meet with them, doesn't bring it up at that time, I always do. I don't like surprises with clients. I try to be as transparent and upfront about that as possible. So if you're meeting with an attorney and they don't bring it up, ask.
Anyone else?
I have a question for John. You mentioned a 20% qualified business income deduction. Does that deduction come off your personal income tax
Right, yeah.
if you have a business?
There's a new line on that, on one of those postcards. There's a line, that's a new line. It says, it's called a qualified business deduction. Qualified business income deduction, yeah. But you've got to, if you're an employee, and you can't take 20% against your wages, it's got to be a self-employed business. Yeah, that's a pretty good one for the right people.
Hey, John, on that same line, farming. Once you expense everything, when you end up with adjusted gross, could you still take that
Yeah.
amount?
Yeah.
Okay.
If you're an active farmer, if you own land and you rent it to somebody, you don't get it that way,
Yeah.
but you've got to be an active participant.
So you can't be an absentee landowner.
There's gray areas of that. Sometimes if you're crop sharing, you know, you might be able to do it. You don't have to actually sit on the tractor necessarily, but you have to be active.
Okay, anyone else? Okay.
John,
John?
if you have property in Florida and you rent the property out to people that travel to Florida in the wintertime, is that a business expense?
That, for the 20% rule, I would say no. If there's that's one of the grayest areas that's causing all these delays and concerns and so on, is just what is considered a business. But a rental operation, there are times when it can be considered a business. Depends on how active you are in it. If there's a rule where if you spend over 250 hours a year managing it, then it's active. But the property in Florida that you rent out, I doubt if you'd spend 250 hours a year on. But, so I don't think that one would probably fly. If you had maybe 15 properties and you were spending over 250 hours on those 15, then you'd have a business of renting properties, and that would work, I think. But I know like triple net leases where you aren't responsible for hardly anything except collecting the rent, those don't fly. One thing, when we're talking about the charitable donation, something that if you're not over 70 and a half, and you might think, well, I can't do the qualified charitable distribution, but maybe what can I do? Am I just going to lose my charitable donations? Again, if you can take a standard deduction, $26,000, and it's almost like if you give $10,000 a year to charity, it's just sort of going to waste as far as tax deductibility. But another strategy is to bunch your charitable donations, maybe double up, do donations doubled or even tripled in one year to get you over the $26,000. Then don't, basically it's prepaying your charities, and then the next year you don't give anything, and then you take the standard. So one year you might take the $30,000 because you gave away a lot of that for charities, and the next year you get $26,000 even though you didn't give anything to the charity. So it's called a bunching strategy, and that might work for those people that are under 70 and a half until they hit 70 and a half. Then they can do the qualified charitable distribution.
Anyone else? Oh, we certainly want to thank you three for all this very excellent information. Now, I have just a couple of parting words. And when I go on bus trips with Joan, we always laughingly call this, now the commercial. She usually does it, but I'm going to try this afternoon. We want to thank our presenters. We want to thank all of you who attended this afternoon, and I certainly hope that each and every one of you go home with some new ideas about exactly what you want to do with what you have worked so hard to obtain. We are in the business of legacy gifts. When I got on the board, we didn't know what they were. We didn't know what planned giving was. We certainly have come a long ways since then. For example, we currently have 32 planned gifts. 19 have already been received, and with some of these funds, we have been able to give toward the remodeling of the oncology department to the tune of $250,000. So planned giving does make a difference. And before you leave, and I see there's still refreshments, I guess they could take part with. You each have a folder, and inside the folder you will find information about lots of things that the foundation is involved with. There are copies of our legacy, Leave a Legacy paperwork. We have some other information about some of the programs that we are sponsoring. And we want you to consider a legacy in the future for the CGH Health Foundation program. Thank you.